Hello everyone, welcome to Intermediate Accounting 2. My name is Anne Marie Anderson and I will be your instructor for this course. So to begin with Chapter 12, which is the investments chapter, this is really one of our major first departures from what you know as traditional financial accounting. Intermediate 2 accounting is a whole new ballgame than Intermediate 1 accounting because there are a lot of hot topics that we'll cover that were not covered in traditional financial and Intermediate 1 accounting. So to begin with, as I mentioned, this chapter is going to be on investments and how we account for those investments. Our focus in this chapter is going to be how investments are recorded on our financial statements, how they're accounted for. And there are a couple of different ways that we account for these investments that actually are a departure from traditional GAAP, where traditional GAAP has always said that we record investments for what we paid for them, historical market price. Well, we've had some new options come up in the past decade or so, and those are some of the options we're going to explore. So we're going to be looking at debt securities and equity securities, and we're not going to be looking at us as a corporation issuing them to somebody else. We're going to be looking at it from the perspective of we are the buying corporation. We are buying bonds and notes, and we are buying common and preferred stock of other companies. And the question is going to be, how do we report these items on the balance sheet and actually in the income statement? Now I realize when I click to this slide that this is actually rather a shocking slide to look at, but this is a really good summary of everything we're going to be talking about. One of the ways we decide on how we're going to report investments is going to be how much control we have over the company that we're investing with. So the first thing we're going to be looking at is we're going to be looking at what if we buy stocks or bonds of a company, but we do not have significant influence over the company. And here they say the investee. So if we lack significant influence, we're going to fall into this area here. If we do have significant influence over the company that we are investing with, then we are going to be using the equity method, which is down here. And then if we actually control the company, we own more than 50% of the voting stock of the investee, the company that we are investing with, we're going to be looking at the consolidation method. So we're going to explore all three of these, whether we lack significant influence, we have significant influence, or whether we actually control the company. So if you look at these numbers here, lacking significant influence is traditionally less than 20%. We own less than 20% of the company, of the stocks of the company. If we own between 20 and 50% of the company, then we have significant influence. If we own more than 50%, then we actually control the company, the investee. We may not actually control them, but that's how the numbers are calculated. That's how we're using this as a guideline. And it is important to notice that it is a guideline because if let's say we own 15% of the company, technically that would put us into this lacking significant influence category. However, what if 15% ownership is actually the largest ownership in the company? Well, that would actually put us more in a controlling or significant influence area. So these numbers are a guideline that we're going to be using, but it is important to realize that even if we don't fit into these numbers as neatly as they're laid out here, we may still fall into different categories. Okay, so the first one we're going to be looking at is going to be lacking significant influence. And we're going to be looking at the three categories of lacking significant influence. So we're going to be the categories are held to maturity, trading securities, and securities available for sale. Now we internally decide what categories our stocks and bonds and stuff. Oops, I went too far. Hang on. Okay, there we go. So the first one I said we're going to be looking at is we're going to be looking at lacking significant influence. And these are our three categories: held to maturity, trading securities, and available for sale. Held to maturity is only used for debt equity because, quite simply, stocks don't mature. So equities don't fall into this area, this held to maturity category. The treatment of any unrealized holding gains or losses are not recognized, and I realize you don't know about unrealized holding gains or losses, but we will deal with that in the next few slides. The investments reporting the balance sheet at amortized cost. Trading securities are different. These can be used either for debt or equity. It depends on what you plan on doing with the securities that you're buying. Do you plan on buying them and immediately reselling them for the most part? Do you actively trade your investments? If that's the case, then those investments belong in this trading securities category. And as far as treatment of unrealized holding gains or losses, we recognize them in net income and in retained earnings as part of stockholders' equity, and we report them on the balance sheet at fair value. All right, we will go into detail on this, and we will go into some calculations on this in a few slides. Available for sale. This is for debt or equity that doesn't qualify as either held to maturity or trading, and these are pretty much the stocks and such that you're buying for the purpose of reselling at some point, but you don't have a plan to actively trade it. So it's as if you bought some stocks or you bought some bonds and you're holding on to it, and you're not necessarily going to hold it to maturity, and you're not necessarily going to sell it immediately either. So they're just basic investments fall into this available for sale category. All right. The unrealized holding gains or losses are recognized in other comprehensive income and in accumulated other comprehensive income. The investment is reported in the balance sheet at fair value, the same as trading securities are. All right, so the major difference between the way these two are reported is trading securities have gains and losses recognized in net income, and available for sale securities are recognized in other comprehensive income, not actually directly in net income on the income statement. All right, so let's look at our first category in more detail, which is the held to maturity securities. As mentioned earlier, securities in this category only should be your debt securities, because equity securities just don't mature. They're good pretty much forever. But the only thing that can be in here, as it says, is their investments in bonds or other debt security that have a specified maturity date. All right, you record them initially at cost, and you would have to have the intention of holding this security until its maturity. All right, you don't necessarily have to. If you decide to sell it after 5 years and it's a 10-year bond, that's fine that it was held in the held to maturity category. The idea is just that is your intent at the time, is to hold this equity, this debt equity, until its maturity date, and it can be recorded on the balance sheet as held to maturity security, and you record it at amortized cost. And we'll get into the numbers on that in a moment. But amortized cost, as it says here, is basically the face value of the equity, of the debt equity, less any unamortized discount or plus unamortized premium.